Well, with the 10-year Treasury yielding 4.2% or 420 basis points, needless to say, mortgage rates are really high. China delayed their Q3 GDP numbers. I wonder why. Maybe the Federal Reserve did a field trip to the world that we all live in and bought some food, got some gas, and paid some bills because they trotted out a governor today saying they might go 50 instead of 75 basis points. They're in their next meeting. Good luck with that. And looks like what's his name did get after the mortgage market. His liquidity is starting to dry up again. This is too eerily close to what 2008 started off to be. Welcome back to This Week in Mortgage, everybody. My name is Sam Batania, your mortgage broker here at Guaranteed Rate in Beverly Hills, right on Cannon. Hope you had a great week. All right, well, we have a 4.20 yield on the 10-year Treasury. Haven't seen this number since 2008. And mortgage rates are actually much higher than they were in 2008 for that matter. And I'll get to why that's the case. But this jump in mortgage rates caused in September existing home sales to drop 23% year over year from last year, 2021. And this number is actually a 10-year low in existing home sales. And I'll tell you this, if the Federal Reserve does not stop doing what they're doing, we haven't seen the worst. The worst is yet to come unless they do a major about face, as all of this just harkens back too close to me to big shades of 2008. Moving on to China, they delayed their Q3 GDP reading, and we seem to ignore it here for some reason. I'd say, wow. What are they hiding? What do they know? And what do they not want us to know? I don't know if we can always trust their numbers, but the fact that they didn't even put any out might be a scary thing. And I think that was kind of just swept under the rug this week. So we're going to see what happens here, but I'm wondering why China did delay their numbers, because at the end of the day, they could have just made something up and sent it to us, not like anybody can go check. So this is a bit troubling that kind of got swept under the rug here. Couple this China news with the war in Eastern Europe that keeps going for some odd reason, and the uncertainty with our friends across the pond in the United Kingdom. I'm not sure how the Federal Reserve is going to keep down this path of blinders when it comes to inflation. They really are doing some things here that nobody knows how they're going to continue to do it. You couple all of these international things, all this uncertainty, honest to God, at the end of the day, not only the Federal Reserve, but who knows? Moving on to the Federal Reserve. All right, so they maybe they went on a field trip and went and bought some gas and food and paid a couple electric bills because they trotted out one of the governors today to say they might go 50 instead of 75. And market's not closed yet. It's Friday morning here, California, but markets seem to like that. And it's a bit of a joke, to be honest with you, because what's the difference between 50 and 75? Because at the end of the day, we're not going to see the effects of this rate hike because they're going to be cutting rates, I hope, before we see the effects of this working its way in the system. They are still trying for this 2% inflation number, and I'm still trying to play in the NBA. So good luck with that. They're never going to get 2% inflation. And if they keep up with this, and that's their main goal, they're going to put us into a depression. I'm not the only one saying this. There's some people a lot smarter than me, a lot more tenured than me, who can see the writing on the wall. If the Federal Reserve really wants 2% inflation, they're going to have to get a depression first, which that's literally the definition of the baby in the bathwater. And if they do keep this up, I will say they will get the Paper Plate Award for the worst Federal Reserve regime, for a lack of better, ever. This is a really easy one. If you look back, they had it right. I'm going to say this again. We printed $5 trillion, dumped it in the economy. Before they got scared by their own shadow, they said it was transitory. Once everybody started paying $7 for gas in California, it's now all of a sudden not transitory, and they've done nothing. So I'm going to give them in advance the Paper Plate Award for hiking rates headed into a recession, and if they keep going, put us into a depression. So they will probably, if they keep this up, go down as the worst Federal Reserve Board of Governor regime ever. And we'll get a Paper Plate Award out to them. And then here's my troubling thing for the week. And I don't want to be negative all the time, but I'm also not going to, blow smoke at you. Mortgage market's not good. Liquidity is actually starting to dry up again. This is shades of 2008. This will be a disaster if we lose liquidity in the mortgage market, because then even the high rates won't matter, because no one's going to want to lend because they can't, because they're not allowed to, or they can't, or their investors or their depositors aren't in for that. So the rates are actually working counterintuitively right now. Some lenders, some banks, some institutions don't want to lend even at these higher rates where you'd think they'd make more money. They don't even want to lend. It's not worth their time. Rates have gone up so high so fast that they believe if they fund a loan today, that in the next 6 months or a year, it's going to run off of their balance sheet and they're going to get refinanced and pay it off. And I hope they're right. But this is actually very counterintuitive. People don't want to lend because rates are too high, in the belief that rates are going to come down. It's not worth their time lending today, which then exasperates the problem and fulfills its own prophecy, for a lack of better. So liquidity is becoming an issue in the mortgage market. I hope I can say something positive about mortgage liquidity, because this, back in 2008, was the first sign of the major collapse that we had in the global economy, was the liquidity piece, because that's literally going to be contagious to every bank and lender on a move forward basis. Okay, everybody, that is my show for this week. I hope you enjoyed it. As always, if you have any mortgage related questions, please don't hesitate to reach out to me. Thank you as always for watching. Have a great weekend, and please stay safe.